If you're investing in ETFs, you're already onto a great start, but you may have noticed that all ETFs carry an ongoing charge. In this video, I'm going to quickly go through what this ongoing charge is and how they actually take away this charge. So although ETFs are passively managed, they're not actively managed by a fund provider. They do, however, incur a fee. The ongoing charge fees of the OCF cover the costs of running the fund even though they are passive. These also include charges of actually marketing the fund and distributing it, which is actually never free. These charges and expenses can reduce the potential growth of your investment, especially in earlier years when you have less money and that is a high percentage of your overall portfolio. So the ongoing charge, or the total expense ratio, is often given as a percentage and calculated as if you are holding that amount annually. So this is the amount you'll pay for over a year, providing you hold this investment for a year. The OCF can usually be found in the key investor information pack, which is usually found as a PDF at the bottom of your investment platform for each ETF. So the OCF as a charge is taken out daily, so you don't actually ever feel this charge. So whenever you log into your investment platform, whether it's Vanguard or Trading 212, the value that you see when the market is open actually reflects the charges taken away, meaning that you will never actually notice these charges. The OCF will never be taken from your current balance. Unlike having a platform provider like Vanguard, they often take management fees which can come out of your available balance. However, the OCF is never taken from your available balance. The OCF includes the fund management fees, and these include charges relating to things like accounting, auditing fees, custodian fees, and many other small fees such as legal fees. So essentially, the OCF can be taken out from the capital or the income. So for example, some ETFs pay dividends. Sometimes it can be taken away from that. It's important to understand that the OCF therefore is not taken from each individual, but instead is taken from the fund's money, meaning that you don't have to worry as an individual investor that it's going to come away from you. However, it is still important to know that higher OCF charges or total expense ratios can contribute to a reduction in your overall gains in the long term. The difference between a 0.07 total expense ratio and a 0.5 is actually very significant. Therefore, it is usually always best practice to go for an ETF that has a low cost if you're holding it on for the long term, to ensure that you get the maximum possible gain in the future as your investments grow. And lastly, on top of the OCF, investment providers can also have additional costs. It is very important therefore that you go and check case by case what these extra charges may be. Small charges are very easy to overlook, but in the long term they can take away from hundreds to even thousands of pounds in potential gain. Make sure to check out some of my other videos and I will see you in the next video.